Congratulations on a very strong quarter, Dougal.
Thanks, Duncan. As you know, our firm's been around for over 35 years now, and this is in the top handfuls of quarters over our long history. Of course, it's long overdue, but we're very pleased over the quarter.
The question on everybody's lips is this the start or the end for value? I guess, has value woken from its slumber?
It probably won't surprise you to know, Duncan, that I firmly believe it's the beginning, and I'll talk you through a couple of charts as to why I think that. The first chart on the screen here is the performance of growth versus value as represented by the S&P 200 indices. Now you'll see the performance in October and November was very strong for value, but in fact value actually underperformed growth into December. But the most important fact is that in the context of a decade of underperformance, the rebound in value is quite small.
Clearly a shift in sentiment to value. What was the main catalyst?
As you know, Duncan, we don't spend too much time trying to forecast catalysts, but looking backwards, it's pretty clear a few things happened during the quarter. First of all, the vaccine news was very promising. Secondly, we had the US election result, obviously, and both those drove long bond yields higher, which was good for value. Back to my point about why I don't think it's over, if you look at this next chart on the screen, which shows the PEs of the 40 most expensive stocks in our market. Now, as you can see from the chart, whilst they have come back from the absolute peaks, the PEs remain extremely high at around 45 times forward earnings, or about 3 or 4 standard deviations expensive. So we think there is a fair bit of scope for the stocks in that category, the most expensive stocks in our market, to derate, and of course that again would be good for value.
You mentioned the value rotation, especially evident in November, and the fact that hyper-growth stocks also continue to perform. Do you think there's potential reversion in these names?
Yeah, I do, Duncan, and that takes me to my third chart. You can see that for this chart, we've divided the market up into 3 buckets, if you will. Remembering the market itself was very strong during the quarter, did about 14%. So in that first bucket, we've included what I'd call our traditional value names. And you can see some of them did exceptionally well. Some of the cyclicals up over 50% during the quarter alone. The second bucket contains the traditional growth stocks, and I'll use CSL as the prime example of that. What is clear from that is they didn't actually fall very far. CSL was basically flat over the quarter. So they went sideways in a very strong market. So they underperformed but didn't go backwards. My final point, and to your question, in that third bucket, what I call the hyper growth stocks, may actually kept rallying during the quarter. And some like Afterpay, which had very strong 9 months before then, rallied a further 50% during the quarter. So yes, I think there's a lot of scope for those hyper PE stocks to come back a long way. And again, that would be very positive for value.
Q4 saw a dramatic pickup in corporate activity. Do you expect this to continue into 2021?
Yes, Duncan, I think that trend will continue. As to what extent is obviously hard to forecast. My reasons for that are simply that debt is cheap and growth is scarce. So private equity firms, other competitors in the marketplace looking for growth using cheap debt, I think that corporate activity is likely to continue.
The market as a whole still seems to be trading on the expensive side. Are there any sectors where you still see value?
Yeah, I think that's a good point, Duncan. And don't forget the market PE as a whole is influenced by these hyper PE stocks, the growth stocks, as I said, trading on 45 times earnings. Within the market, there's some definitely patches of value. We are now overweight the banking sector for the first time in many, many years. The banks have obviously had a pretty volatile run over the last year, but as the COVID situation improves, bad debt expenses are likely to be written back in our view, so we could be facing some earnings upgrades, possibly even dividend upgrades for the banks. Energy remains very depressed and we're again still overweight that sector. So yes, there are definitely some pockets of value in what is otherwise a fairly expensive market.
Finally, Dougal, looking into 2021, do you have any concerns?
I think there's 2 concerns, Duncan. First of all, it's COVID. It's very hard to forecast and hence to predict. We hope for good news there, but that's always impossible to tell. The second one, which is more concerning for me as an investor, is the rise in long bond yields. Particularly for those who own those growth stocks, we've had the benefit of the falling bond yields for many, many years. Bond yields have started to tick up, particularly since the US election, and that could well be a concern for many of those high growth stocks.